So equity can be used for personal use, such as purchasing a car, renovating a house, purchasing a boat if you really wanted to. You can use it for gardening, you can use it for extensions, etc. Whatever you want. Majority of the lenders out there will only let you borrow up to 80% of the value of the property without lender's mortgage insurance. Even though that you have a lot of equity in your property, you still have to show the bank that you have the ability to service the loan. There is no need to ever cross-collateralize a property because that will just make life a lot harder for you down the track. Drawing equity out, it will make life that much harder. I can guarantee it. Good day everybody, and thanks for joining me in another episode of the Mortgage Chat. I'm your host Tony Xia, and today we're going to talk about using equity. So let's start off with what is actually equity? Well, equity is essentially an increase in value from an asset you actually hold. So let's say I purchased a property back in 2015 for $800,000 and now it's worth 1.4 mil in 2024. So essentially throughout all those years, I've built up equity of around $600,000. And that's essentially equity I can leverage off and use. So equity can be used for personal use such as purchasing a car, renovating a house, purchasing a boat if you really wanted to. You can use it for gardening, you can use it for extensions, etc. Whatever you want. Or you can use it for personal use, which is using it to invest in stocks, using it to invest in other properties, etc. Or you can use it for investment use, such as purchasing other investment properties, or using it to purchase stocks, or you can use it for investments, such as purchasing other properties or purchasing stocks, anything related. So there are lenders out there that actually let you use equity for whatever purpose you want, as long as there is equity there and you can service the loan. But the most important thing is working out what sort of equity the lender will allow you to use. Because majority of the lenders out there will only let you borrow up to 80% of the value of the property without lender's mortgage insurance. Let's say for argument's sakes, my property is worth $1 million. The bank will only lend you up to 80% of the $1 million, which is $800,000. If your loan is $800,000, therefore there's no usable equity there. So any dollar you take above $800,000, you have to pay lender's mortgage insurance, which defeats the purpose. However, if your loan is only, call it $500,000, $500,000 take away $800,000, that means you got a usable equity of $300,000 you can use for personal use or investment use. However, what I always say is, if you take equity out for investment use, you should always split the loan for different usages. So let's go back to the prior example. My original loan was $500,000, which is, call it my owner-occupied loan, non-tax deductible. And my usable equity was $300,000, which I'm going to use for investment purposes. Call it my 20% deposit plus stamp duty for my next investment property. So how you should be structuring the loan is, you'll have loan number one, which is $500,000, my existing loan. And you have loan number two, which is $300,000, which was used for investment purposes. So therefore, you have two loans against the one security. So you can segregate the usage for what purpose. And also, it makes life a little bit easier for your accountant down the track when they're doing your tax returns. Like I just mentioned, even though that you have a lot of equity in your property, you still have to show the bank that you have the ability to service the loan if you want to take equity out. So it doesn't matter if you have $2 million worth of equity. If you have no income, or inability to show that you can service the loan or whatever equity you want to take out, the bank would not lend you the money. Even if your property is worth $1.5 million and you only have a $300,000 loan on it, if you want to take out $100,000 equity to renovate the home or build a pool or whatever you want to call it, if you don't have the ability to show that you can service the loan for your existing loan plus the cash out, the bank wouldn't lend it to you. So equity is one thing, but borrowing power is another thing. And a lot of first-time buyers or first-time investors out there are probably asking, how do people build up this portfolio and keep on buying and buying and buying properties? This is because they can leverage off existing properties. They can leverage off the existing value, the existing capital, the existing equity of that property for them to be able to keep on purchasing. It's what we call the power of leveraging. So I'm going to give a quick example. We had a client where we were able to draw out $500,000 worth of equity. And this equity allowed them to purchase another 3 or 4 properties down the track as an investment. For them to save up $500,000, it's going to take a lifetime. So that's why having equity in your property is so important as part of your investment journey. So a lot of people ask, hey Tony, is it better to use cash or is it better to use equity? Well, in my personal opinion, we should always try to use equity first and park the money, which is your own savings, in the offset account for a rainy day. Because once you use that money and something happens, your income changes, your financial situation changes, then it'll be very hard to take that cash back out, especially when your income drops or lending policy changes. So yes, what I always say is borrow the maximum you can, use the bank's money first, and leave the money in the offset account for a rainy day, because you're not paying any interest on that portion of the loan anyway when it's offsetted. So you're essentially holding free money. And in addition, if you have owner-occupied debts and you want to buy an investment, you should never use your own cash. You should always borrow as much as you can to maximize your tax deductions from that loan. And you should be parking that cash in the offset account against your owner-occupied loan to reduce the interest charge for that particular loan, because that loan is non-tax deductible. So another thing a lot of people don't know is how to better structure your loan. So let's say for argument's sake, I had no equity, I got an owner-occupied property, but I got $200,000 in cash and I want to buy an investment property. I can guarantee you, majority of the people out there that don't get proper advice will use that $200,000 cash savings as a deposit for the investment property. So instead of using that $200,000 cash as a deposit for your investment, what you should be doing is you should be using that $200,000 loan and pay down your owner-occupied debt by $200,000. Call it from $500,000 down to $300,000. And you'll retake that $200,000 equity out for investment use. So now you have 2 loans against your owner-occupied loan. The first loan, which was your original home loan, that you paid down from $500,000 down to $300,000. Then you have loan number 2, which is the loan you took out for investment use, which is $200,000, where you paid it down and retook it back out. So therefore, you have loan number 1, which is $300,000. Your original loan is non-tax deductible and your original owner-occupied loan. Then you have loan number 2, which is the $200,000 you retaken it back out for investment purposes. This is loan number 2. So what you've essentially done there is you've paid down your non-tax deductible debt by $200,000, but you've increased your tax deductible debt by $200,000. And this $200,000 will be used for the deposit plus cost for your next investment property. Let's call it your 20% deposit plus stamp duty. Then on your new investment, you'll only borrow 80% of the purchase price against that property. A lot of the advisors out there will ask you to cross-collateralize it, where they join all the loans together in all the properties. But if you just done what I've told you, there is no need to ever cross-collateralize a property, because that will just make life a lot harder for you down the track. Doesn't matter if you want to sell it, refinance it, drawing equity out, it will make life that much harder. I can guarantee it. So everyone, this was just a short video about how to use equity and what you can use it for and how does it work. I hope you enjoyed it, and I'll see you next time.